A pandemic happens and the stock market is back at all-time highs within 6 months. U.S. headline inflation hits the highest levels in over 50 years, and the stock market makes a new all-time high within a year. A trade war rips apart the economic fabric that has defined global trade since World War II. Within 3 months, the stock market is back at all-time highs. And now, a natural war breaks out, disrupting the supply of the most essential commodity that powers the global economy. And within just a few weeks, the stock market is back to all-time highs. We've seen this time and time again for the last 15 years. Every single stock market correction was immediately bought back up. But don't get used to it, because the very things that have been causing this behavior, this relentless buy-the-dip psychology, are completely reversing as we speak. For the majority of investors, this is going to be a wake-up call, causing tremendous amount of pain. But for a small fraction of investors who are willing to make the right decisions, it is leading right into generational wealth-building opportunities. And I'm going to show you exactly what those are. In just the last 12 months, the S&P 500 index is up by over 50%. Real GDP growth in the US during this period was equivalent to just 2.5%. With the war in Iran triggering a sharp jump in the price of oil, estimates now suggest that GDP growth is hovering closer to 1.2%, 2% annually. It seems like no matter what happens to the US economy, no matter how bad it gets, nothing can actually stop the stock market from making new all-time highs in very short order. But this has not always been the case. Between 1998 and 2011, the average annual return of the S&P 500 was close to 0%. And that was with real GDP growth being at roughly the same level as it is today. So that was more than a full decade where the stock market was not able to outperform the economy. We have very similar results for the period between 1973 and 1980, a 7-year stretch, and the same thing happened between 1929 and 1954, a 24-year stretch, where the stock market matched the mediocre economy. Now, believe it or not, this is not a fake stock market. There are real reasons for why this has been happening. If we compare the performance of the S&P 500 index against the growth of corporate profits over the last 15 years, we actually see that corporate profits have grown at the same pace as the S&P 500 index through a sovereign debt crisis in Europe, a global pandemic, an oil shock from Russia, a trade war, and like we've seen in 100 years, and now the closure of the Strait of Hormuz. Now, during the same period of time, GDP growth in the United States has actually grown by less than a quarter of the S&P 500's performance. And real personal income, meaning how much people are earning from their salaries, has grown by 1/10 of the S&P 500's performance. So here is the real divergence that needs to be looked at. How has corporate America been able to grow its profits at such an incredible pace despite salaries essentially staying flat over the last 15 years? But, as we're going to see, this may not last much longer. Warren Buffett famously said the following statement: "In my opinion, you have to be wildly optimistic to believe that corporate profits as a percentage of GDP can, for any sustained period, hold much above 6%. This is an incredibly important statement to consider today, because if we look at what corporate profits are as a percentage of GDP today, they currently stand at 12%. This is double what Warren Buffett has suggested as the roof for corporate profits as a percentage of the economy. What's even more impressive is that we've been significantly above this range for the last 15 years now. Now, it's important to understand why corporate profits should theoretically stay capped as a percentage of GDP, and there are 2 key reasons. The first is that high corporate profits naturally attract competition. For example, if Company A is able to make its costs substantially lower than its revenues, you're very likely going to see new companies coming into the market to compete with Company A. Those new companies will try to win customers over by offering lower prices, which will eventually force Company A to lower its prices in order to stay competitive. The second reason for why corporate profits are usually capped is what we call the negative feedback loop. When corporate profits grow to become a very large chunk of GDP, it naturally means that the rest of the economy has shrunk in proportion to corporate profits. That's usually at the expense of wages for workers. And given that workers are consumers, if their wages are declining, it will weaken their demand for goods and services, which will naturally lead to lower corporate profits. This is why most of the time corporate profits don't exceed a certain level. And this is why throughout most of financial history, we've generally seen corporate profits and personal income grow at more or less the same speed. So the question today is, what has allowed corporate profits to defy gravity? Now, while there are multiple factors that are contributing to this gap, there is one key variable that defines our entire financial system and is indirectly responsible for everything that is happening today, And this is key to understand because the very same force could, for better or worse, make it all reverse. And this force is none other than the U.S. Central Bank, the Federal Reserve. Now, it may not have meant to cause these problems, but the way it is set up inevitably leads to this outcome. Whenever a big economic crisis hits the real economy, the Fed injects liquidity and lowers its interest rate in order to stabilize the financial system. The problem with this is that the Federal Reserve injects liquidity straight through the banking system, and this disproportionately benefits large borrowers, which happens to be large corporations. So, in other words, every time a big crisis hits, the money flows to corporate America. A big chunk of it gets pocketed as pure profits and only some trickles down to the salaries of the average worker. As the U.S. Treasury Secretary has put it, the Fed is an engine of inequality. So the very design of the Federal Reserve, which controls the supply of our U.S. dollars, has led to much more of a cushion for the profit of corporations than it has for the average American salary. And this is in large part what has helped this gap become what it is today. But as we mentioned earlier, things are about to change radically. This is the 4-year average of the core inflation rate in the U.S. And as you can see, in the 2000s and 2010s, U.S. core inflation hovered systematically below 3%. This low inflation environment has allowed the Federal Reserve to systematically step in to bail out corporate America at any sign of weakness. Whether that is the great financial crisis, the Federal Reserve was able to cut rates to 0% and inject massive amounts of liquidity. In response to the pandemic in 2020, the Federal Reserve cut rates to 0% and injected massive amounts of liquidity. All of this was only possible thanks to the low inflation environment that was in place during that period. But now look at what's happened in the last few years. Core inflation in the U.S. has been rising and sticking around at the highest levels since the 1980s. In response, the Federal Reserve has had to keep interest rates high despite record low consumer confidence and multiple weak GDP prints during this period. In fact, we could very much see a scenario where inflation stays extremely sticky and the Federal Reserve is forced to raise their interest rate once again. If this were to happen, it would immediately remove all of the cushion that was provided to big corporations in the last 15 years. Now, we're not there yet, and this is why the stock market is strong today and could actually continue being strong in the coming months. But we think there's a good chance the Fed begins raising interest rates by as soon as the end of this year. And this is the very thing that caused corporate profits to collapse in 2008, in 2001, and multiple times in the 1970s. Now, this does not mean you should be selling your entire stock portfolio, but you should be preparing yourself to take advantage of the massive opportunities that are going to come from higher levels of volatility in the coming years. Planning ahead of time for these periods is what can allow you to take advantage of the pain instead of doing what 90% of investors are going to do, which is sell at the bottom. Now, we are currently allocating capital to areas of the market that we think can perform well despite the market volatility. There are certain parts of the market that can see unbelievable returns in this kind of market environment. In fact, we've allocated roughly 80% of the Bravos research portfolio to just 10 stocks within these sectors. The first is biotech. Some companies here are making major breakthroughs and massive amounts of capital is pouring into the space. The biotech sector has already run up by 80% just in the last year, significantly outperforming the S&P 500, but we think there's a lot of room to run and there's some incredible stocks within this sector that we think can see outstanding returns. The base metal mining sector is another sector that we've been allocating to, and it has outperformed the S&P 500 by over 100%. We've been holding multiple positions in this sector for the last few months. But this is just the beginning. Base metals are the raw input for electrification, data centers, and all of the infrastructure that is powering the current technology boom. This is the AI trade that nobody is talking about and that will be turbocharged by higher inflation and deglobalization.